Hi everyone, Abraman here again. We are still on the discounted cash flow method, and today I'm going to examine the net present value method. So it said the net present value, which is what NPV, the short form is NPV, N for net, present for P, and value for V. So the net present value method is the difference. The net present value, when you say net is what to, is the difference between the whole and what to, and the cost. So just like net profit, at this revenue minus what, minus cost, as simple as that. So you have your what, you have your net profit. But in this case, we call it what, net present value, because of the effect of what, of discounting, because we normally discount, because we are still under the discounted cash flow method. Anything we are doing here, we have to discount the cash flow given to us for us to arrive at what, the present value. Okay, so the net present value is different between an investment market value and its cost. Are we together now? So it's different between what to an investment market value and the cost in which you bought the investment. Then, as simple as that. The difference between the two is what is known as the net present value, because you bring the future cash flow, you bring it down to the present day in order for you to know how much the worth of that cash flow in future. So at the present time, you bring the future back to the present. That is the net present value. Okay. It measures how much value is added or created, as the case may be, today by undertaking the investment. What I'm trying to say here, what this is telling us is that, take for example, an investment that gives you a stream of inflow over a period of 5 years. You as a finance manager, you as the person appraising the project, you need to know whether you should invest on that project or not. So what you just do is what? Get the list of what, you already know what the capital cost of the project will be. So you now determine what will be the inflow from this investment over the period of what, or the time given. So all this cash flow, we now do what? You now discount the cash flow to its present value. So from there, you accumulate it and deduct your initial cost, as simple as that. So from there, you have your net present. So at this point, it will tell you whether the investment is worthwhile or not, based on on the cash flow that you are going to receive from the investment. So by that, therefore, it is defined as the difference between an investment market value and its cost. Just two variables, just two things: the market value of that investment and the cost. So revenue minus cost, you have your you have your the present value, you have your net present value. It measures how much value is created or added today by undertaking the investment. So, and this is the formula for net present value. C1 is what? Cash flow in year one. You are going to do what? All over, this is discounting factor. So, open a bracket, 1 plus R. R is the discount rate given to us because of capital. It's in that discount rate. So, in year one, you have it on and on like that. If it is more than 2, so N, so it means what? Number of years to the end of what? Number of years given to us of the cash flow we want to do what? Discount to its present value. This is what C1 in year 1, year 2, year 3, year 4, as case may be, N to the end. So minus the cost. As simple as that. Where CO is what? Initial outlay or cost. The initial cost you incur on such investment is what? Is your initial outlay. C is what? Is the relevant cash flows. The relevant cash flows. So this C, you are seeing your relevant cash flow for year 1, relevant cash flow for year 2, and on and on like that. While N, the end we have here is what? The project life. the project life. So maybe the project is going to use 4 years, for example. So it now got C1 plus C2, C1 over 1 into opening bracket 1 plus R is power 1 for year 1, for year 2 is power 2, for year 3 is power 3, for year 4 is power 4, as the case may be. So minus all the initial cost, as simple as that. From there, you are going to arrive at your NPV. So therefore, for you to now make a decision, a positive NPV represents an unrealized capital gain. So after you have accumulated your inflow, you now subtract your outflow from it. So if you have a positive NPV represents an unrealized capital gain. It represents the money that you are going to do you are going to realize, but still you have not is yet to be realized. So you'll be realizing it year in, year out over the time period. So it also represents an immediate increase in the weight of a company if the project is accepted. That is, when after appraising a project using the NPV value and you have the positive NPV, it means definitely is going to do increase the weight of the company. So the aim of appraising projects is to do is to take decision on whether to invest or not to invest, as simple as that. So we also have decision criteria for net present value. We have decision criteria for net present value. So let's look at the decision criteria for net present value, which I've stated, but let's look at it, let's tabulate it. So it's a decision rule. Decision rule 1. Okay, let's have it. If this means that and you. So let's have our decision rules there. So 1, NPV greater than 0. If NPV is greater than 0, this means that the investment is expected to increase the shareholders' wealth. And you should do what? Accept the project, accept the investment. 2, if NPV less than 0, this means that the investment is expected to decrease the shareholders. But and you should do what? Reject. Criteria 3. NPV is equal to 0. NPV is equal to 0. The investment is expected not to change the shareholders' wealth. And you are indifferent between depending on other okay, and you say greater than 0, that is positive. So this one, that is negative. So this one, that is break even. Okay. This is the decision rule. For you to make your decision, you have to follow these rules. Now, the first criteria, the first scenario is if the NPV is greater than 0, that is, you have positive. The answer you result you now get at the end of the day is what is positive. So this means that the investment is expected to increase the shareholders' wealth. If the answer result is positive, and you accept the project, accept the investment, is worthwhile, it's okay, it's good to go. But if the NPV is what? Less than 0, that is negative. This means that the investment is expected to decrease the shareholders' wealth, and you reject the project. You should reject the project. Let me add should here, and you should okay. 3. NPV is equal to 0, that is break even. The investment is expected not to change the shareholders' wealth at this break even point. No gain, no loss. So, and you are indifferent between accepting or rejecting the project depending on other qualitative factors. In this scenario, what you should do is you don't know what to do because the NPV is equal to 0, that is you break even. So you don't know what to do, whether to accept or reject the project. So base your judgment on other qualitative factors. In my previous videos, in one of the previous videos, I've talked about qualitative factors. If you don't know what those qualitative factors are, just refer to the video that speaks on qualitative factors. So qualitative factors are those factors that could not be easily quantified. So some of those words, this computation we are doing here, these are quantitative factors because we have in quantity, in value. So those factors which cannot be easily quantified, these are what we call quantitative factors. Take for example, if I want to buy a machinery and I now appraise it based on this and have a result of at NPV of 0. So you now look at other qualitative factors such as what will now be the effect on this purchasing this machinery on taxation. If if I purchase this investment, this machinery, will it reduce my what to my profits, my tax payable? What effect will it have on what to on taxation? Will it help to do what to reduce my taxable profits? If you can get that very well, if you can ascertain that, fine. You can then what to it will help you to do what to decide whether to buy or not to buy. And also the machinery, if it is what it will be used to do what to produce one of your core products. If one of the major products in the company, the one of what the research center, the project, the quantity that is your core area that your company is known for. So we still have to consider that factor in which what okay, this what to indeed if I'm looking at it in that perspective, so fine from there I can tend to do what to buy this particular machinery. So those are qualitative factors. What will be the effect on what? On inflation, on taxation, on the way our customers look at the company in terms of what to not producing that particular product, we not buy the machine. So therefore, these are decision criteria in which will to help you to guide in making a certain decision using the NPV method. So that is NPV for us. At this junction, I'm going to call it a day. So expect my subsequent videos on internal rate of return, modified direct rate of return, profitability index, benefit cost ratio, which are other words which are still under the discounted cash flow method. So permit me to do what to exit the class for now. And please, if you have not subscribed to the YouTube channel, kindly do that by clicking on the subscribe button. Please, I would really appreciate. And if there's anything you notice, please kindly put that on the comment section, and I'll be glad to respond to your comment. Thank you and God bless.